U.S. stocks have had a strong start to the month of March. They say that March comes in like a lion and goes out like a lamb. As for the equity markets on Friday, we saw the Dow top its first 17,000 level for the first time since January. And also we saw the S&P 500 notch a key level. So joining me this afternoon to weigh in on the market action, as well as the Fed rate outlook, we have Stephen Guilfoyle of Deep Value Executions and David Williams of Strategic Gold. Gentlemen, thank you so much for joining me.
Thank you for having us.
Thanks for having us.
Well, first and foremost, we finally got the jobs report. It did come in mixed when you look at the unemployment rate, non-farm payrolls, average hourly wages. So what do you make of that report?
Well, generally speaking, it's a positive. I mean, when you bump up the participation rate, when more Americans are either working or looking for work, it's a positive. Unfortunately, the negative side of that coin is downward pressure on wages and hours worked. So now we're battling with this as the Fed's trying to make their decision regarding monetary policy. We've seen a touch of core inflation of late. Without the double-edged sword that is wage increases, where does that leave the Fed? We have a little decision making to make going forward.
And David, you're a gold person, so I do want to ask you about gold and what all of this means for that precious metal. Can you give us your outlook?
Sure. I think what the Sarge said is right on point and very interesting. You also have to look at whatever statistics they're actually going off of. Sarge actually uses some other statistics that maybe drills a little bit deeper below the headlines. And what you see is that there's plenty of uncertainty, whether it's what the Fed is going to do, whether it's what's happening in the general economy, or whether it's just stocks in general if they're overpriced. And so when it comes to our expertise in gold, gold has had a 5-year down cycle, bear market, and now this year it's lifting its head and coming out of it. And that reflects really, well, many factors, but it reflects what's happening in the market in general, that there is a lot of risk out there, and people are starting to understand that and realize that there is risk involved.
And gentlemen, since we've addressed the fundamentals, I want to go to technicals. We're seeing key resistance levels being breached today in the equity market. So Sarge, can you tell us what you're watching?
Well, interestingly, from the highs in November to the low of February 11th to now, we are seeing precisely a 61.8% Fibonacci retracement, which is pretty good for a mathematician from Italy who was just charting the price of fish 500 years ago. For short-term trading levels, we're bumping up against 2005 on the S&P 500. We've hit it 1, 2, 3 times today. If we can get above that, we can go all the way to 2014 short-term. But then we hit next week, and we hit the ECB with Mario Draghi and a whole new cast of problems and different things to tackle. So that'll be a short-term trade.
David, I want to bring you into this conversation now. Sarge has referred to what we're seeing in terms of volatility as the 4 horsemen. So Sarge, can you explain that to our audience and how gold plays into this?
Well, you know, when you look at, basically when people are scared, they run into gold, they run to the VIX, they run to utilities, they run to treasuries. Those are the 4 horsemen of the safety dance, all right? Which was a popular song in the 80s if you're a nerd like me. Gold may be breaking away from the other 3 horsemen, all right? Gold, to me, is starting to trade more like a currency. It's starting to differentiate itself, and it's breaking up the dance a little. But for the first 6 to 8 weeks of this year, that was a pretty popular trade, and utilities were the leading sector for 2 months. I think that trade is finally starting to break up a little bit, but it's something when you see the market get nervous, because we've had a nice run here now. We're on a technical trend line here for a couple of weeks, which is almost incredible. When you see the market get nervous, which inevitably they will, probably sometime next week, those are the 4 items you're going to watch.
And David, of course, I want to get your take on this. When you're looking at gold prices, you have to look at what's happening in the broader market as well as all these indicators.
Exactly. And I think initially, at the beginning of this year, gold was bouncing off lows from at the end of last year in the, let's say, 1070, 1080 level, $1,700 or $1,070, $1,080 level per ounce of gold. At the beginning of this year, gold started going on its run. It's been on a two and a couple weeks worth run. Technically, you were asking earlier. Technically, it's probably pretty stretched. It's probably at the end, and yet today we're bouncing off yearly highs. It hasn't been this high in 52 weeks, and that's because there's a large fund, a Blackstone fund, that said that they were shutting down the issuance of gold shares now, that it's going to continue to trade. It's a large ETF, it's going to continue to trade, but they're not going to issue any more shares, and that's a lack of physical gold. This is the reason they're doing it. So gold has a couple things going for it. First of all, it's on a 5-year lows, and so it's ready for a little bit of a bull run. Secondly, a lot of different fundamental factors are coming into play, and then you hit these technicals where versus the Dow versus other things. It's generally been, like Sarge said, some sort of insurance policy. Well, all of those are kicking in at the same time, and it's 18% since June 1st. It's up 18% since June 1st. That's probably too stretched. It's probably got to come back a little bit, but short term is always very difficult to predict, but medium and long term, I think it has much further to go because of the fundamentals driving behind it.
Will we see profit taking in gold ahead of the ECB meeting?
I think yes, but it's going to be short-lived, and my reasoning behind that is I believe the ECB has got to continue easing at some point. So the profit taking will come in because gold is already stretched. But as soon as there comes out some sort of news that says, "Oh my gosh, begin to get your insurance game, begin to panic," they could flood right back into it and go after the gold trade again. So that could be a very dicey spot there.
Well, David and Sarge, we've covered the equity markets as well as gold, but we can't leave oil out there hanging in the wind. We got that Baker Hughes report, and everybody was watching that before we headed into the weekend. So what do you make of that, and where will oil prices go from here?
The rig count, the U.S. rig count is now approaching almost, I think, 60-year lows, something like that. And if you saw what happened in Canada, I mean, my goodness gracious, it went from, I think, 175 rigs down to about 130 or so. I'm not sure the precise number, but a tremendous drop in total North American rig count. And that's part of the reason why you're seeing oil trade on future fundamentals such as that, which cut production, not on the 10 million barrels you saw pop into the supply this week. I think $34, $33.50, $34 is now your support level for WTI crude. I think we're going to approach the $40 level for resistance, and that is where you will actually start running into increased production from the U.S. shale producers, and that'll probably keep the price in check.
On the gold question, or on the oil question also, it's very interesting to me that since the beginning of the year, commodities in general are up somewhere in the area of 5-6%. That dovetails into the gold trade. I believe that gold is a currency versus a commodity, but it's been held in commodities for so long, as a commodity for so long, and that goes into the oil trade. Well, if commodities in general are starting to lift their heads a little bit, that just bodes well for oil because of the factors that Sarge is talking about, as well as the background.
Which brings in another factor, which is the U.S. dollar, which if Mario Draghi pours some kerosene on the fire next week, that could also strengthen the dollar, which will weaken these commodities.
And that's true. Next week, we get that ECB rate decision, so we'll be watching that. Last but not least, before I let you go, what is your Fed rate outlook? When can we expect any movement?
There's a 0% chance they'll raise rates in March. There's almost a 0% chance they'll raise rates in April now. You probably have to go as far out as October or November to find a spot where there's more than a 50% chance. But the caveat here is core inflation, all right? Year-over-year CPI, core CPI, is now at 2.2%, above the rate that the Fed was targeting. The core PCE is now at 1.7%. They both were up 0.3% month over month last month. And that was when we had good wage growth. Now we don't have wage growth. If inflation's still out of the bag without the wage growth to go with it, I think the Fed may have to raise rates when they don't want to. They may have to raise rates before June if inflation is there, because they can't let that one get away. If that genie gets out of the bottle, that goes back to the gold guy here.
My opinion is I think they struggled to raise rates 25 basis points last year. It was a tremendous struggle to do that. I think they talk a good game about raising rates. I don't think they're going to raise rates. I think they are trapped and they can't raise rates. The debt overhangs are massive, and there's all sorts of debt issues and collateral issues behind that debt. And so I think they are in a massive box, and I don't think they're going to raise rates. Period. They're going to talk about it. They're going to get us all excited, but I don't think it's going to happen.
Well, gentlemen, thank you so much for joining me on this Friday, and thanks for this discussion today.
Thank you, Remy.
Thank you.
Thank you, Remy.